while everybody else is investing in Microsoft and getting 24% or 55%, the elite do it in a specific way where they're making thousands of percentage points. The story doesn't get told, and I'm going to reveal the story today on how this is done. Let's talk about high quality stocks for a second here. You know, people think that in order to invest in a thing that goes up 3,000%, that they have to buy some stock in some company that has barely even gotten off the ground, right? They think they have to buy these stocks that are trading at $1 that are probably losing money and don't have their management team really even in place yet. These high risk things that might go to zero or might never go higher than $1 a share. But that's not the case. You know, they think they need to be in some experimental crypto token or be lucky enough to be in a biotech stock before they get an FDA approval. They think that if they're going to get those 3,000% winners, they have to invest in something crappy.
The ground floor phenomenon.
Right, before it becomes a great looking company. And that's not at all the case. And that's exactly what I'm talking about when we discuss the elite and the well-connected and how they get to enjoy low-risk investments with high profits. And I mean super high profits, multi-1,000% profits. Most people don't think that you can have a low-risk investment that goes up 3,000, 4,000%.
Mm-hmm. And by elite, you don't even mean the 1%. You mean like the 1% of 1%.
Yeah. Well, I mean, you think about the 1%, right? Mm-hmm. Which listen, a lot of people like to think that the 1% are people that are wealthy or entrepreneurs or these big, bad, evil people, and then they were all born with a silver spoon in their mouth. You know, most of the people that I know that are billionaires came from nothing. So I just want to say that and put that out on the table. But there are, you know, the elite, they whether you worked for it or whether you were born into it, they get things that average people don't get. They get access, they buy their kids way into colleges. They enjoy the trust fund money sometimes that mommy and daddy left them or gave them. They get to sit at the front row, you know, half court at the game, and they work at the entry level position, starting out as the VP of the company.
Yeah, for $600,000 a year or something.
Exactly. Oh, I don't know anybody who's in that position. You said it, I didn't. I don't want to end up on the side of it. So the elite actually get to enjoy those huge crypto-like returns, but instead of having to take these huge risks like the rest of the world takes, they can do it with trillion-dollar companies, the companies that everybody knows, the Facebooks, Teslas, Nvidias, Microsofts. While everybody else is investing in Microsoft and getting 24% or 55%, the elite do it in a specific way where they're making thousands of percentage points. And I'm not just talking about some high-risk call option strategy or some vertical spread or something like that. I'm talking about something that has lower risk than individual stocks.
And these companies are the opposite of the ones you described that are trading for $1 and may never trade any higher.
These are companies that are practically part of the government. These are the companies that the government would not even allow to fail. Bill, this is a story that's never really been told to the mainstream investing world, and it's one that your money manager does not want you to know about for good reason. You'd probably leave him or her in a second as soon as you get it. But I learned this strategy from the smartest hedge fund manager that I've ever met. And I can't believe she isn't super famous. She's the smartest investor that I know. She specifically asked me not to reveal her identity. But you know, the story doesn't get told, and I'm going to reveal the story today on how this is done.
I know when people hear of this strategy for the first time, and I've been there when you've had conversations with people, and I've seen you introduce this to them, it sounds impossible when you first hear it. Yeah. So could you walk through exactly how the strategy works?
Well, the first thing to know is that when you get into the position, if it goes in the wrong direction, if you're in a bullish position and you want to trade higher, if it goes in the wrong direction, your position that you took, it's not exactly the stock position itself. You're investing in something that moves because of the stock position moving. Okay, and it is in the options market, but it's not what most people probably think. When people think options, they think a lottery ticket. They think taking a high risk position and hopefully getting a high reward. This is a very specific, very specialized type of options trade, and it's investing in options that are low risk. The first thing you have to know is that options were created to decrease risk. They were created as an insurance policy. They were created to hedge. So options were initially not created as some sort of a high-risk speculative investment. The way that it works is if you invest in something and it goes in the wrong direction, the first thing you want to think about is your risk management, what could go wrong. When you learn to ride a motorcycle, you first learn how to fall. It's the first thing you learn.
Yeah.
So if you're in a position and goes in the wrong direction, the option that you're in becomes much less sensitive. So the stock goes down 10 points, your option might go down 6 or 7 points, maybe 8 points. But if the stock goes up 10 points, that same option will go up 7.5, 8, 9, 10 points. So the more right you are, the more sensitive your option becomes. Have you ever bought 1,000 shares of stock and then it traded higher and then you wished that you had bought more stock?
Yeah, I wish I had 10,000 of these.
Right. Well, this actually happens with this strategy. Like you go into this option position and the more right you are, as the stock continues to move higher and higher, it's like you're getting more and more shares of the stock. It's like if you wanted to buy 1,000 shares of stock and then the stock goes higher and then you can take a time machine and go back and buy another 300 shares of that stock.
Knowing in advance because it went higher.
On the flip side, if the stock goes in the wrong direction, you bought 1,000 shares. Don't you wish you could take a time machine and go back and say, I only wanted 700 shares of that stock?
Yeah.
I only wanted 500. I only wanted 200 shares of that stock. Well, that's pretty much what happens with this options position. So if you have a stock that goes down, from 100 down to 80, then your option position might only go down 10 points when the stock went down 20 points. If the stock goes from 100 to 120, then your option position might go up 19 points. So down 10 or up 19. The stock went down 20 or up 20, your option went down 10 or up 19. So that is an immediate edge that you get from using this strategy. So if you think about it in those terms, if you had a stock that went up and down 20 points over and over again for eternity, you would make lots of money on this position because when it went up, you're making a lot more. When it goes down, you're losing a lot less over and over and over again. And that's when you start pulling money off the table, removing your risk, and then completely eliminating your risk.
Yeah, and the beauty of it is they're long-term positions because there are these companies that, I think the way you described them was these are the companies that they're practically part of the government. They're almost guaranteed to be around for a very long time and they're super strong. So you can have confidence being in these positions while they keep doing that.
Yeah, if the stock pulls back, you don't want to panic, right? If the stock pulls back, a lot of people would get out in order to limit their risk. But for us, if the stock pulls back, it's automatically limited. Automatically. You don't have to do anything. On the flip side, if the stock goes higher and higher, you're actually pulling your risk off the table. So I have an animation that I want to put up on the screen. Hopefully we can put the animation up on the screen here because a picture's worth 1,000 words and I'm a visual person. So the open position value is represented by that blue block. Okay, so it's a $10 call option. Stock goes up, let's just say 8 points. And the call option goes up 7 points. Now it's at $17. At that point, let's just say it's Microsoft for argument's sake. At that point, we sell out of one Microsoft call option and we buy a different Microsoft call option. So we're still in Microsoft. Microsoft still can go higher, we'll profit from it. Sold out of one Microsoft call, bought another Microsoft call, but we bought a Microsoft call that's cheaper than the one that we sold out of. So we sold one at 17 and we're buying a new one at 12. So that remaining 5 points we put to the side. Then we wait another month, wait for the next checkpoint. If Microsoft goes higher, this option goes up from 12 up to 21. So it's gone up 9 points. Maybe the stock went up 10 points. So this call went up 9 points to 21. What you do is you sell out of that call option at 21 and you buy another Microsoft call option that's cheaper at 14. So you've taken another 7 points, you put it on the side. So far, we've collected 5-point dividend and a 7-point dividend. That's 12 points. The initial investment was 10. At this point, your risk is completely removed, and you also have an option still that's worth $14. It's still trading. All right, that option goes up on this graph anyway, on this animation, to $27. We're going to take some of that and repeat the process. It's an 11-point checkpoint. All right, we can check 11 points, pull it off the table. Now you've got 23 points checked, and the option is trading at $16. And it just continues on from there. I'm just going to let this animation play out. But hopefully the visual makes sense for people. I think that the key takeaway here is that you're locking in your gains without locking yourself out of future profits.
And at some point, literally, like mathematically, 100% of your risk is gone. You're playing with house money.
Right.
It's almost what you just described. It's like if someone came along and said, "Chris, can I pay you every month to be in Microsoft?" to have exposure to Microsoft, and every month I'll send you money for doing it.
Well, just imagine if you invested in an option at $10,000, and you pulled 5,000 off the table, and then you pulled 7,000 off the table, right? You've put $12,000 on the side, and you still have an option that's trading at 14. You wake up one morning and the market has crashed. How do you feel?
How do I feel?
Yeah.
A lot better than someone who owns Microsoft stock.
You've pulled your money off the table. So, I mean, and guess what? You have a call option.
I don't care if Microsoft crashed if I've already gotten paid back.
Not only that, but Microsoft, it's not like you have a stop loss. A lot of people, they like to mitigate their losses by putting stop loss orders in. So if the stock trades down below a certain point, it automatically gets sold. But a lot of those people see the stock trade down, it gets sold, and then it recovers because it snaps back after a crash or after a correction or something like that. But with options, this option might go from 14 down to 3, and you're saying, well, at least I pulled the 12 points off the table. What the hell? Let's go have a beer or something. Yeah. And then, but you hold on to the Microsoft call option, and then Microsoft comes back and starts breaking highs again. You didn't get stopped out of your position. So now you've got an option that's trading at 23, 33, and so on. The point is that you have a less stressful life, right?
Yep.
I mean, you want to make money, but you don't want to lose years on your life from stress. Stress is the biggest killer there is, right? I mean, you can see it in people's faces sometimes. They work so hard and they're so stressed, especially day traders. I mean, you want to just chill on the beach or chill with your family in the mountains and just enjoy life.